Hello, I'm Sonia Rehill with the Motley Fool, and I'm joined by Stuart Watson, our Premium Services Editor. Hello, Stuart.
Hi, Sonia.
And we're here today to talk about funds versus shares. Now, Stuart, most people end up buying funds when they start investing. Why do you think that is?
Well, there's a few reasons, I think. I mean, first of all, it's easier to buy a fund than an individual share. You don't have to take a view on a company's management. You don't have to look at its accounts. Mm-hmm. You also get instant diversification with the fund. So when you buy a fund, you're buying perhaps dozens, even hundreds of companies. And that gives you a broad mix of sectors. So if one industry is doing poorly, you might find you're invested in another industry which is doing well, and that sort of evens itself out. And lastly, I think there's a big marketing machine behind these funds. So particularly in ISA season, which is sort of March, April time each year, you'll find that there's adverts everywhere for funds, and lots of people buy funds on the back of that. Okay,
so 7 out of 10 fund managers underperform the market. Mm-hmm. Why do you think that is?
Yeah, I mean, this is a stat which surprises many people when they first come across it. But if you think about it, it's not actually that unexpected. So you could say beating the market is an index like the FTSE 100, which is merely the average performance of all shares. So you could say, well, given that, shouldn't 50% do worse and 50% do better? Mm-hmm. But then you need to bear costs in mind. So you've got upfront costs of, say, 5% when you buy a fund. There's an ongoing management charge, which is another 1.5% each year, perhaps. And then there's a cost of the manager buying and selling the shares within that fund, paying things like stamp duty and stuff like that. And these sound like small amounts, but they all add up year after year. So when you look at the long-term performance of funds, then you'll find that 70 or perhaps even more will underperform the market.
Okay, so how can private investors outperform the market significantly? I mean, I keep hearing about these 10-baggers and multi-baggers. What are they, and how easy are they to find?
Well, a 10-bagger is simply a company that's gone up 10 times in value from, say, £1 to £10. Mm-hmm. They're fairly rare, and we did a report quite recently, and we looked at this. We looked at all the companies in the FTSE All-Share, which is about 700 companies, and we found about 13, I think, which are 10 bags over the last 10 years, so only about 2%, so pretty rare.
Can you give us some examples?
Yeah, sure. So one would be a company like Domino's, Domino's Pizza. It's a very simple to understand business. That's gone up about 16, 17 times in the last 10 years, so that's one thing that might surprise investors. That a business like that, just rolling out new branches can produce those multi-size gains.
Okay, any more examples?
So resource stocks have also done very well. So a gold miner, Randgold Resources, is up about, I think, 27 times in the last 10 years. So that's got a series of mines. It's built up in Africa. And oil is another one, so on the resource side. So Tullow Oil, also in Africa, has done very well. That's up about 12 or 13 times. So,
and this is over the last 10 years?
This is the last 10 years, yeah.
Wow, okay. So it looks like private investors can beat the market significantly, but you just need to look for good companies and look where other investors aren't.
Yep, that's a good way to summarise it, I think.
Wonderful. Thank you, Stuart. The tickers that we've discussed today are Domino's, DOM, Randgold Resources, RRS, and Tullow Oil, TLW. Thanks for watching.